In this lesson, we're going to take a look at a very common scenario whenever the economy is doing poorly or whenever a lot of companies are bankrupt or are on the brink of bankruptcy, which is what happens when a government or another party steps in and actually bails out a company. Now, there's a lot of confusion about this, but the actual accounting treatment of a bailout is very simple, and it's similar to a couple other things that we've actually seen before in some of these other tutorials. So the actual accounting behind a bailout is fairly simple overall. So what I'm going to do is show you how to actually translate this in accounting terms to the three financial statements, and then we'll go through an example of how you bail out a company with equity by injecting cash into the company, and then how you bail out a company by issuing debt or some type of debt-related instrument like preferred stock as well. So first off, the first point I want to cover here is that the point of a bailout, the reason why a company normally needs to be bailed out is that they're in a cash crunch. So maybe the value of their assets has declined greatly, and so as a result they've had all these write-downs, and so their cash balance has fallen a lot, and in most cases they just no longer have enough cash to actually fund their operations. So it's time for payroll, or they have to order inventory and they just don't have enough cash to continue operating as a company. And so that's the most common reason for requiring a bailout. And even when banks need to be bailed out, it's for pretty much the same reason, which is that they're short on cash. Now in their case, it's not that they need to order inventory or anything like that, but it's more that they do not have enough cash to actually borrow and lend money to different parties. And so that's what's causing the cash crunch and why they need to be bailed out. So with that in mind, keep in mind that the motivation for any type of bailout is to increase a company's cash balance. And the way you do that, of course, is you adjust the other side of the balance sheet so that either debt or shareholders' equity is going up to balance this increase in cash that you have. So the first example I want to go through with you here is with an equity bailout. So I'm going to go over to our interview questions at the top, and I'm going to enter 100 into equity bailout changes by. I'm going to start with the income statement to show you what happens here. As with many of the other scenarios we looked at, there are no changes on the income statement all the way down to net income here. On the cash flow statement, a bailout is not part of a company's operational or investing activities, so there are no changes on these areas. Under financing activities, here's where the bailout actually shows up in cash terms. So our cash flow from financing here goes up by 100 to reflect the fact that this 100 of additional cash is coming in from the government or from a sovereign wealth fund or from some kind of other party here. And then as a result, at the bottom of the cash flow statement, our cash is up by 100 here. Now moving over to the balance sheet, so what happens in this scenario is that cash is up by 100 because we know that from the bottom of our cash flow statement, cash is up by 100. So total assets here are up by 100. On the liabilities and shareholders' equity side, no changes to liabilities. And so what actually happens here is that under shareholders' equity goes up by 100 as a result of this equity infusion, this equity bailout from another party. And if you want to get technical here, more specific, what happens is that on the common stock goes up by the par value times however many new shares were created and however many new shares this other entity actually bought in the company. And then the additional paid-in capital goes up by the difference between the share value and the par value of the stock times the number of shares that were issued and then purchased by this new entity. So in this case, basically what I've assumed is that whatever sovereign wealth fund or whatever government is actually bailing this company out is investing in the company at this $10 per share current share price right here. We're still assuming the $1 per share par value of the stock right there. And so as a result, common stock here goes up by 10 million, additional paid-in capital goes up by 90 million. The only other change here is that on the income statement below net income, shares outstanding would go up by 10 million here, and so our earnings per share would fall. But that's really all an equity bailout is. It's really just another form of issuing stock and then having another party like a sovereign wealth fund or a governmental entity come in and actually buy the stock, which gives the company additional cash and gives them an ownership interest in the company now. Now, one other point I want to mention with equity bailouts here before we move on to debt bailouts is that when you invest in another company, and let's say you're a sovereign wealth fund or something like that, one thing you have to be careful of here is that when you start the scenario, you want to ask what share price they're investing in. In this example and in the model here, I've assumed that they're just investing at the current share price, but often what happens is that they're actually investing at, say, $5 per share or $2 per share. So they're essentially getting a bargain, a discount on the company. When that happens, what you want to do here is confirm with the interviewer first. Before you even begin answering this type of question, always confirm with the interviewer, is this a debt bailout, an equity bailout? And if it's an equity bailout, what share price are they investing in the company at? If it's a debt bailout, what type of debt instrument are they buying? So right now, support for investing at a different share price is not built into this model, but if you want to see what would happen, I'm just going to enter equity bailout right here. I'm going to still say 100 million, but this time we're going to change around some of the parameters. So our cash flow from financing would still go up by 100. Our cash here would still go up by 100. But what would happen in this case is that if we're investing at $5 per share and we're investing 100 million, if you think about it, what would happen in this case is that our common stock would actually go up by 20 million here because we're investing at $5 per share. We're buying 20 million of additional shares. The par value of each share is $1. So actually our common stock here would go up by 20 instead. And then for additional paid-in capital, so if you think about it, we have $4. That's the value of the stock over the par value. So we have 5 minus 1 for $4 right here. And then we're buying 20 million shares, so this is a difference of 80 million. So our additional paid-in capital here would go up by 80 million instead. So it would actually be 180 million here. Both sides of the balance sheet still balance. And then under shares outstanding, this would actually go up, and instead of being 110 million, this would go up by 20 million instead. So this would be 120 million. So that's how investing at a slightly lower share price would actually impact our model here. Basically, the investor is getting a bargain because the company is still getting the same amount of cash, but the investor is getting a larger ownership stake because they're getting more shares. The common stock line item here would be a higher value, and the additional paid-in capital will be a lower value because they're investing at a lower share price. And then earnings per share here would fall by a greater amount, and shares outstanding would go up by a higher amount in this case. So that's how you would model it out in the scenario where the company was not receiving an investment at $10 per share, but was instead getting it at $5 per share, as in this example. So I'm just going to undo all those changes that I just made. So that's how an equity bailout works. Now let's look at the flip side and look at how a debt bailout works. So I'm going to enter 100 in the long-term debt changes by category right here. And all that happens for a debt bailout is that in the cash flow statement, no changes to the first two. You see this long-term debt being issued under financing activities. Balance sheet, cash goes up by 100, assets are up by 100, and then on the liability side, debt is up by 100, so liabilities and shareholders' equity are up by 100. So all a debt bailout means is that the company essentially has issued new debt, a new investor has come along to buy it, and then their cash balance goes up and their debt goes up on the other side to balance it. So that's all a debt bailout is. Now there are a couple other scenarios here. You could have a case where the investors invest in preferred stock or convertibles or something like that instead, and the impact for all of these is really going to be the same, which is that either shareholders' equity is going to go up or that something else on the liabilities section, so maybe a different type of debt or convertibles or something like that would go up, and then cash on the asset side would go up. So basically whenever you have a bailout, what's happening is that cash is going up and then something is going up on the liabilities or shareholders' equity side to balance that. And this could be preferred stock, this could be common stock as in the example we looked at, this could be a different type of debt. But that's basically what's happening whenever you have a bailout like this. So that's a quick overview of how both equity and debt bailouts work in the context of accounting and the three financial statements. Whenever you get a question like this in an interview, the first thing you want to ask is, what type of bailout is it? Is it debt, preferred stock, some other type of security? Is it an equity infusion, just giving the company cash? Figure out what type of bailout it is, and then figure out the specifics. So if it's an equity bailout, for example, ask what share price they're investing in, ask what the company's current share price is, their par value, their stock, get all the details first, and then go through. And if it's an equity investment, it's just like issuing new stock, essentially. And if it's a debt bailout, then it's really just like issuing new debt or any type of debt-related instrument like preferred stock.